How's everyone doing? Welcome to the Strategy Room on this Saturday night, January 10th, 2026. This is our first live stream of 2026, and it is good to be back. It's kind of amazing. You take a couple weeks off and feels like you've been gone forever. But I have been putting up new episodes every for the last 3 weeks. Been all new episodes coming out every day. I just haven't been doing the live streams. Just took a couple weeks off for the holidays for the live streams, but now I'm back and I'm tan and I'm rested. Well, maybe not so much. Maybe not so much tan. But as usual, I have a great show for everybody tonight. We're actually going to be this is kind of a catch up night because not only are we going to go over all of the news and everything that just came out over the last couple of days, as far as like GDP, economic numbers, some of the things that Trump is proposing with using 200 billion in bonds to try to drive down mortgage rates. We're going to talk about all that great stuff tonight. I got a little bit of Fed information for everyone. We're also going to look back on some of the things that we may have missed over the last couple of weeks. Well, while I had my little hiatus. So we've got a lot of stuff to go into tonight. Got fresh economic indicators for everybody for what's coming up in the week ahead. I have looking back. I've put out how many? 12, I think 17 episodes in the last 3 weeks. So we'll talk about those a little bit. Some of them got some interesting reactions. I did one on tariffs. I got a lot of downvotes on that one. I thought that was kind of funny. So we'll talk about that one a little bit later in the show. But before we get started, before I kind of jump into all the usual stuff, I just wanted to do a little reset, if you will, here at the beginning. So for anybody who is kind of new to the channel or hasn't experienced the strategy room yet, or the banker next door, the channel, I would just say that basically this is an educational channel. I'm not here to sell anybody anything. This is just pure education on the banking industry, on the financial services industry, just really studying and just analyzing economics. What is going on with banking in terms of regulation? How are banks performing? What's happening in the commercial real estate market? And I try to look at really any and all aspects in the banking world, as far as talking about IPOs and M&A and capital raises, and we talk about bank strategy. We talk about products. And I have all kinds of reports and everything that I constantly come in on. A lot of times I'll do what I call report week, where I get kind of backed up. I get so many reports, I just kind of put them all out there and cover them over a week. And I cover all kinds of things from the OCC, from the Federal Reserve, from the FDIC, from FinCEN. Put all kinds of things out there just to try to keep people up to date, try to keep people as abreast the best I can on just what's happening in the economy, what's happening in the world of banking. And I look for a couple primary people. I mean, there's definitely a demographic that I look for, and that is, I'm looking for people that are in the financial services world. If you work in banking or you work in financial services, but you're a financial services professional. Maybe you're an accountant. Maybe you're a commercial real estate attorney. Maybe you're a commercial realtor, commercial appraiser. Anybody in kind of the financial services world in any way, shape, or form. I like to think that this is the podcast for you if this is what you're looking for. And then also, I'm looking for students. I'm looking for high school and college students that are basically trying to, maybe they're very interested about business and finance. Maybe they'd like to learn a little bit more about this world. So I'm hoping that they could tune into this podcast and they could watch and they could get a real good understanding on not only, what's going on, but where things are at. If they're looking for key sources of data, hopefully they can find that here with a lot of the analysis, again, and things that I do. So that's kind of my main, target audience, my main demographic of the people I'm looking for with this podcast. But also, I hope too that, hey, anybody out there, anybody in general that wants to learn about, like I said, banking or the world of financial services, I keep this open to anyone and everyone. So anybody who wants to come in here, wants to learn a little something, like I said, I think there's a little something for everybody here. And I do a lot of different stuff on the channel as far as interviews, special series like the Lords of Easy Money or the crypto series, or, I cover AI and bank technology. cover a lot of different things here on the channel. Do a lot of book reviews. We talk about a lot of different books here, all business related, but books nonetheless. So, like I said, a lot of things. I try to cover, some movies, business related documentaries, just for a little bit of more of a pop culture flavor, if you will. But that's it. Basically, that's really what I'm looking to offer as far as content here on the channel. And like I said, so anybody out there that like I said, that just maybe they're just really into finance, really into banking and economics and things like that. This is definitely the channel for them. Okay, so let's jump in. That all being said, let's jump into it. So as we usually do, we start off with taking a look at the U.S. debt clock. I like to update everybody on the numbers. So we are still cruising at a U.S. national debt now up to $38.5 trillion. The debt per citizen is now up to $112,580. Debt per taxpayer, $355,810. How about that? U.S. federal spending still a tad over 7 trillion. The U.S. federal budget deficit is now at 1.725 trillion. Now, I will say that over the last year, they have really been able to actually make a dent in this, because we were a little over $2 trillion at this time last year. So it's come down 275 billion. So that's not, I mean, it's definitely nowhere near we want to be, but it's certainly not an insignificant number either. So, that really helps. I would point out tariff revenue here is up to 370 billion, and that's revenue per taxpayer. That's $3,247 per taxpayer. Now, one thing I don't like, the debt to GDP is now up to 124%. We were actually going in a better direction. Throughout the year last year, that had come down to about 120%, but now it's back up to 124%. Going in the wrong direction, man, going in the wrong direction. But this is something I harped on all of last year. I will harp on it again all of this year. We have to get the spending down. You cannot begin to reduce the national debt. It's like anything else. You need a surplus of funds first before you can begin to bring the national debt down. So you have to get this federal budget deficit down. We have to get back to a balanced budget. We have to cut $1.7 trillion out of this federal budget deficit. And I'm sorry to tell everybody this. I don't think Congress has any appetite to cut spending at all. I said that all last year. I still say it again. I mean, I think we're going to have to go supernova on Congress. That's both sides of the aisle. That's not. I'm not picking on one side or the other. I'm calling it. I'm calling them all out. Every single last one of them has no desire to cut spending. I said that all last year. I'll keep saying it. We have to light a fire under their butts, something fierce, to get them to fix this colossal mess of their creation, not ours, theirs. Okay, what are some of the other things I want to point out here real quick? So defense spending still up to $926 billion, almost $1 trillion in our defense spending. I'll have a little bit more to say about that a little later on, as far as Trump wanting to increase that up to 1.5 trillion. So I don't know about that. We'll have a talk about that. Credit card debt is still hovering at $1.3 trillion. So credit card debt per household, $8,175. So again, so just some interesting numbers. I always like to look at these numbers. I think I know this is a very busy website. There's a lot going on here, but I also think that there are a lot of fascinating things to look at on here. A lot of different numbers here to dissect that you can really dig into for a lot of different reasons. So, but anyway, all right, let's pop in here and take a look at interest rates for a second, because it's been a couple weeks here, and let's go over to our lovely bonds here. And let's take a look. So where is the 10-year T-bill at right now? So we are hovering at 4.175%. Now that, as I had said, if anybody who watched any of the live streams last year, I said that the special rate, the area that we wanted to be at was basically 4%. 4% or less was really what we were looking for to really get where we want to be, which is mortgage rates down in the fives. We need to get that back to probably about 3.5%. And so we were there last year. We were there. If I go to the 1 year, You could see here back, when we got back, when was this about? It looks like about April. We were right there. We were right there at 4%, and then we got down just below that at the kind of mid-November. We were at 9.38, 3.98 or 3.974. Yeah, I'll get it right. One of these times I'll get it right. But we got down into the high threes for just a minute. And that was right. It was right at the sweet spot. That was right where we wanted to be. And we just wanted it to hold there, but it didn't. And it's kind of, like I said, it's been very choppy. It's kind of bounced around, but it has gone a little higher. Now, my expectation, and we'll talk about this a little bit later, especially when we get into the conversation of President Trump wanting to use the $200 billion from Fannie Mae and Freddie Mac profits to dump that back into the bond market and the treasury markets here to basically try to get these rates down to continue to make home ownership as affordable as it can be. So like I said, we'll get back into that a little later. I think the yield curve overall still looking pretty good. I mean, the 2-year T-note is at 3.536. So again, the 10-year and the 2-year, that's what makes up what we call the yield curve. And we look at the difference in that, and we're over a 50 basis point difference there. So that you could think of as what's called like a steepening of the yield curve. So that is pretty good. And obviously the 10-year is also above not just the 2-year note, but it's above the 1-year bill, the 6-month, the 3-month, the 1 month. So we're definitely in positive territory on the yield curve, which is good because one of the things I talked about last year was obviously having a what's called an inverted yield curve for a very long period of time, which is not overall a good thing. Now, I just wanted to point out with stocks, we did come back down a little bit, but we had hit actually 50,000 in the Dow Jones Industrial Average. The S&P 500 had also hit 7,000. So we had hit some huge milestones there, and it was kind of and that was just a couple of days ago. We hit 50,000 in the Dow Jones, and it was just kind of wild to me because I mean I'm thinking back to late 90s when I was in college and I was studying finance and economics undergrad, and just really immersing myself in a lot of this stuff for the first time. And I mean the Dow Jones Industrial Average was under 10,000. I mean, you're at 7,000, 8,000. And then of course in those days we had the dot-com bubble, and we just had this all throughout kind of from 92 to 2000. We just had this kind of surging. We had a couple bumps in the road. Obviously the Mexican peso was an issue in 1995, and then we had the meltdown of long-term capital management. We had what was called the Asian contagion in kind of like 97, 98. So I mean, there certainly were a few bumps in the road back then, but nothing that careened, not until 2000 when the dot-com bubble finally burst, and then the market went down. But yeah, I can remember the market, trying to get to 10,000, and then it went up to 14,000, and then it dropped. Obviously, had the financial crisis, came back down, and it stayed under 14,000 for quite a while. But yeah, these last 15 years or so have been pretty wild ride in the stock market, going up to almost 50,000. So like I said, just some things I wanted to point out there. Now, okay, before we jump into our first story, I had to share this chart with everybody. Now, look at this chart. Looks like a very interesting chart, right? And a picture is worth 1,000 words, right? So I think you look at this, that looks pretty bad. I see a lot of red there. I see what appears to be a dramatically steep cliff. It looks like, matter of fact, it looks like it just something fell off a cliff right here. And that something that fell off a cliff would be the Federal Reserve's earnings. So this is a chart showing the losses in the Federal Reserve over the last few years. So let's just read this little note here at the top here. So Powell lost almost $250 billion realized over the last 4 years. But if you squint, you could see an improvement. It'll be years before the Fed sends another dime to the Treasury in remittances. Taxpayers once again foot the bill. So you could see how bad this is, how much money the Fed has lost. And this is one of the things that this is one of the things that really irks me, because you never see this. They don't show this on CNBC. They don't show this on Bloomberg. They don't show this on Fox Business. You don't see this anywhere. That's why I'm showing it to everybody, so that you could see this and know what a absolutely horrific job that Jeremy Powell has done. When I say that Powell should be fired, yes. Think about that. If you were running any company in this country, any company, I don't care how big or small, if that is the chart showing your profits, you're gone. You're gone. Okay. There just is no justification for that. $250 billion, $250 billion they have lost. Now, you're going to say, well, Joe, well, this is very interesting, but why are you showing it to us? Well, I'm going to now show it to you because of this article, something that just happened here in the last couple of weeks. So right before the end of the year, judge blocks White House's attempt to defund consumer watchdog agency. Republicans have long criticized the Consumer Financial Protection Bureau for what they say are politicized tactics targeting financial institutions. Yes, we know this. That's old news. The federal judge ruled on December 30th that the White House cannot lapse its funding of the Consumer Financial Protection Bureau, a watchdog that has long drawn the ire of congressional Republicans. In a ruling, the U.S. District Judge Amy Berman Jackson wrote that the CFPB should continue to receive its funding from the Federal Reserve despite the central bank operating at a loss. That's interesting. How are they supposed to fund this if they've got no money coming in the door? Now, again, I hear you out there. I hear everybody out there going, well, wait a minute, Joe. It is the Fed, and the Fed can just turn the printing press on, and they could just print whatever amount of money they need to print, or just turn the electric account on and just type some numbers in, and just like magic, the money's there. I get that. I understand that. But I'm talking about that is in theory. I'm talking about reality. The reality is they have no money to give. And what is the big problem with this, right? So I'll get there in just a second. So let's see. So the Trump administration has argued that the CFPB should be dissolved because how it gets its funding is invalid. The CFPB has largely been inoperable since President Donald Trump was sworn into office nearly a year ago. Its employees are mostly forbidden from doing any work, and most of the Bureau's operations this year have been to unwind the work it did under President Joe Biden and even under Trump's first term. The head of the White House Budget Office, Russ Vought, is currently the acting head of the CFPB. The White House earlier this year issued a reduction in force for the CFPB, which would have furloughed or laid off much of the Bureau. In November, the Trump administration's attorney said in a court filing that the Department of Justice memo had concluded that there were no legally available funds at the Federal Reserve for the CFPB to request. The memo, which was issued by the DOJ's Office of Legal Counsel, states that if the Federal Reserve has no profits, it cannot transfer money to the CFPB. Aha, yes, obviously, because the only lawful, there's a key word there, lawful source of funding from the Federal Reserve has dried up, the memo reads. The proper method for obtaining additional funds to request them from Congress pursuant to the Appropriations Clause, not to draw funds from the Federal Reserve without a congressional appropriation. The White House has also stated that the CFPB cannot lawfully draw funds to fund its operations from the Fed if the Fed does not have combined earnings to allocate to the Bureau. Without additional funds, the CFPB is expected to deplete its operating funds completely in January. But in her order, Jackson wrote that the government manufactured arguments to allow for a lapse in funding for the CFPB. So again, and Justice Jackson just, I think, completely goes off the rails here, just saying that, yeah, you just need to go find the money. Just go find the money somewhere. And it's like, well, no. You can't just go and find the money somewhere. Okay. The money has to come from the Fed. Now, why is this a problem? Okay. Well, so a few years back, a bunch of people brought a lawsuit against the CFPB saying that it was unconstitutional. Now, how did they say that the CFPB was unconstitutional? Well, they said it was unconstitutionally funded, meaning that it was part of the Federal Reserve and it was funded by the Federal Reserve, and wait for it, that it should be funded by Congress. And that's what made it unconstitutional. Now, wait for it, here's the best part. However, the Supreme Court Supreme Court came back and ruled that no, funding by the Federal Reserve is constitutional. So they ruled that the way that this is set up and that the way that the CFPB is totally constitutional to be funded by the Fed. But now all of a sudden that the money has dried up, now they want to go back and say, oh, well, hey, you should go get the money from Congress, from appropriations, or just find the money somewhere. It's like, no. Sorry, it don't work like that. If you don't like the fact that there's no money there, then you need to call Jeremy Powell. Justice Jackson should call Jeremy Powell on the phone and say, hey, Jeremy, I was hanging out with Grandma Janet, and we, we're really upset about the fact that you guys have no money to give to the CFPB. What can you do here, man? Can you turn the printing press back on and help us out? And see what he says. See what he says about the whole thing. So, but I just thought I saw this article and I saw this argument from Justice Jackson. I was like, this has got to be the dumbest thing I've ever read. Now, again, I get it. Republicans want to close down the CFPB. The Democrats don't want them to. The Democrats, the Democrats never met a bureaucracy or a government agency that they didn't like. Okay, everything has got, the government has the answers for all of us. Even though they can't get out of their own way, but they got all the answers for us. So again, just an interesting thing that I wanted to point out here. Start the year off on such wonderful news, right? So okay, so that's that. Let's go into some other Fed news here for a minute, shall we? So okay, Fed minutes suggest caution about further rate cuts early next year. At the December meeting, some officials backed holding rates steady for some time. So we shall see what that means. When the Federal Reserve met to cut interest rates this month, meaning December, some officials said they were reluctant to support more easing in the near future, according to the minutes of the meeting published on Tuesday, a sign that further cuts could face resistance at the next meeting in January. The written record of the Fed's December meeting, released after the customary 3-week delay, showed that most members of the Fed's policy committee thought the rates could eventually fall further if inflation declines. The Fed rate cuts at 3 straight meetings to end 2025 as it sought to cushion a weak labor market. Cuts have become increasingly close, all because price increases have been more persistent than the Fed would like, the minutes indicated. Data released after the Fed's meeting indicated inflation cooled in November, but economists have said that the recent government shutdown may have distorted those numbers. Yes, no, not really. Here's the thing, and I said this last year, the Fed's own projections showed that inflation was going to top out at about 2.9% in November or December of 2025. And that basically for the next 2 years, inflation would steadily come back down below 2%, below their 2% target. That is their own projections. So it is wild to me over the last 2-3 months that we have seen all these economists coming out basically saying like, oh, well, this, the inflation's really shown it's really persistent. It's really hanging in there, and this, that, and the other thing. It's like no, it hasn't gone up. It's just stayed there. And I want to try to find something else for you guys here. See if I can show. I'm looking for a true. Here we go. Truflation. I don't know if anybody's ever looked at the Truflation website. Really cool website. Definitely, I recommend go check it out. So Truflation, where do they have the inflation rate at? Well, they've got the CPI at 1.81%. And they have the PCE, which is the Fed's trusted preferred inflation index, at 1.79%. Very interesting. Both of these are below what? Oh, that's right. The Fed's 2% target, right? That's below their inflation target. So the U.S. inflation dropped further today from 1.93% to 1.81%, driven by the dropping prices of natural gas, which drove utilities down. You can check our daily U.S. inflation indexes and their component categories on our website. So yeah, if you ever get a chance, Truflation is a really cool website. I had been meaning to show this a couple of times last year, but I kind of kept forgetting to show it. But yeah, so we will definitely be looking at Truflation's website throughout the year. We'll definitely be checking in using some of their numbers and indicators and things as we go along. But I just wanted to point this out, that this is not, I do not believe that inflation is really the primary motivator anymore. I do not believe that. I think that inflation is going to continue to come down as the year goes along. I mean, the tariff thing is mostly over. We know we already went through that. We saw what the ramifications were, which were really a whole lot of tariff revenue, not so much causing inflation. But we are still, the big concern in my mind right now is the labor market. And we're going to look at some economic data a little bit later on as far as some of the economic indicators that came in on the job market for last week. And we'll take a look at all that, and we'll examine a little bit like where the labor market is. I don't think that there is necessarily a cause for panic per se in the labor market right this second. But there's definitely a weakening in the labor market, and we need to keep our eyes on that. But there's a lot of twists and turns, if you will, in the labor market right now. So like I said, we'll keep an eye on that, and we'll see where we go with that. But all right, let's jump in. And okay, now here is interesting. I call this is some fear corn. Fear corn articles coming in, everybody. How investors are prepared for a new Fed. Markets have been calm despite concerns about a less independent, more divided central bank. Investors are preparing for a very different Federal Reserve in the year ahead. President Trump has signaled that he is closing in on a pick to be the next central bank chair. He has also doubled down on his demand for lower interest rates and recently told the Wall Street Journal that he expects the new leader to be on board with his agenda. I'm shocked. A president of the United States wants the head of the Federal Reserve to be on board with his agenda. Stop the presses. So far, markets have shown few signs of significant concern. That's because there is none. That the Fed would completely surrender its independence. First of all, no, it's not completely surrendering its independence. It's ridiculous. But investors are still bracing for a central bank marked by unusual division, a potentially weaker chair, and the lingering threat of more radical change. Who from the Federal Reserve wrote this article? I mean, seriously. Here's another one for you. Whoever Trump picks, the next Fed chair won't be independent. President's social media posts show worries about Hassett miss the point. Trump's conditions compromise all the candidates. Donald Trump is down to 4 finalists for Federal Reserve Chair. The consensus on Wall Street is that White House advisor Kevin Hassett will get the job. As for who should get the job, many on Wall Street say not Hassett. Why the dissonance? The same thing that makes Hassett the favorite is what worries his critics, that someone so close to Trump can't be an independent central banker, and yet his Fed transition is unique, and that the president wants a Fed chair who doesn't fit traditional notions of independence. He wants someone to support his overall economic agenda, which means lowering interest rates a lot. Trump made this clear in a social media post on Tuesday. He lauded the strong third quarter growth report, then lamented that markets often sell off on good news in anticipation of the Fed raising interest rates to avoid inflation. But again, this is so ridiculous. This again, the bigger issue here is that this is. I need people to understand this is all about legacy. Okay. This is about legacy. Okay. Jeremy Powell brought down, I'll talk about this again a little bit later when I talk about the episodes I did. I did a whole episode here a week ago about how the Federal Reserve had this massive year-end injection in the repo market. And I explained about how the Federal Reserve had reduced their balance sheet down from 9 trillion down to about 6.5 trillion. And in doing so, the consequences of that are they zapped all the liquidity out of the repo market. Now we have some market liquidity problems. So, but again, that is all about legacy. That Jeremy Powell, he didn't do that to help the American people. He didn't do that to help the economy. He did that so that he could come out and write his book in a year and say, and I guarantee this is, mark my words. I want you to mark this down. I guarantee 100% that this is going to happen. Jeremy Powell is going to write his memoir as soon as he's gone in May, or maybe not in May. He might hang around. He still has 2 years left on his term on the board. He may decide to hang around. I don't know. We'll see. But my guess is that Jeremy Powell will go, And when he goes, he'll ride off into the sunset for a little while. He'll go write his memoir, and then he'll be right back out on his book tour. And that whole thing will be, well, I did it. I brought the feds. I tried to fix the problem. We had to spend that money during COVID, and then I tried to do everything I could to fix the balance sheet. Some things just didn't work out the way I liked, but I left the Fed in a much better place than before I got there. Yeah, okay. That's what he's going to try to do, okay? What he is terrified is that Hassett maybe, and there's a big maybe there, but Hassett maybe gets in there and not only throws him under the bus, but throws Janet Yellen under the bus, throws Ben Bernanke under the bus, the what I call the three amigos, the last three chairs of the Federal Reserve. And here's another controversial comment for everybody. I believe that the three amigos will go down in history as the three worst Fed chairs that we have ever had. I truly believe that. I think it will take some time before people come to that conclusion, but I guarantee you there is an economist out there that will write a book in 10 years, 10 years, maybe less, that will basically say that, looking back on their track record and what they did to the economy, there's no doubt that the three of them were they wrecked the economy, wrecked our economy. And so I think he is terrified that Hassett's going to come in there and basically just really, really rain on his parade and cause him a whole lot of consternation, and basically point out all of his problems, all the things that he did, the whopping mess that he was left with from Jeremy Powell. And I think that is what, Powell is all terrified about. And it could be a reason for him to stick around. I don't know. We'll see. Okay. Let's look at a couple of the Fed governors. We're out giving some interviews and speaking at some speaking engagements, and we had some interesting things from them. So Minneapolis Fed's Kashkari indicates interest rates don't need to be cut much more. So Minneapolis Federal Reserve Neil Kashkari told CNBC on Monday that he thinks the central bank is nearing the point where it should stop lowering interest rates. My guess is we're pretty close to neutral right now, Kashkari said. Calibrating neutral is critical for Fed policymakers as they decide whether to continue the streak of 3 consecutive rate cuts implemented in the latter part of 2025. Well, I would say to him, the answer to that is no. I would say that no, we still have a ways to go with cutting interest rates. I would say they need to come down at least another 75 basis points, at least another 75 basis points. I would highly look for at least 325 basis point rate cuts this year. That's what I would be looking for. But no, I do not believe he's right. And furthermore, being the head of the Minneapolis Federal Reserve Bank, I think the bigger question to him should be, how did he not know that there was this massive $18 billion fraud in his own state? How is he not aware of all of this going on? How is he not aware of all these MSB, these money service businesses transferring all this money all over the world and all the other shenanigans that were going on there? I think that would be a legitimate question for Mr. Kashkari, but maybe we'll save that one for another day. Okay, Fed governor, retailers are quietly replacing workers with AI. Here's which jobs disappear first. So, at a DC FinTech Week event last week, Federal Reserve Board Governor Christopher J. Waller suggested that AI is already reshaping the workforce, with some companies replacing customer support and IT roles through attrition. But the transition to AI doesn't always work out. Klarna attempted to replace customer service agents with AI in 2023, but eventually backtracked, hiring humans. Still, Waller acknowledges that some job losses may occur due to AI. However, he remains optimistic about its long-term economic benefits. So again, very interesting there. It's tough to say. I can't say that he's wrong. I think there's definitely some justification for what he's saying there. But it's just one of those things that we'll have to keep an eye on and see how it unfolds. So, all right, let's take a look at where am I at here? Trying to keep an eye on the time, make sure I'm moving us along here at a brisk enough pace. So 4 banking trends to watch in 2026. So this year is poised to show how far the groundwork laid in 2025 can carry the banking space with regard to regulation, mergers and acquisitions, artificial intelligence, and more. So this is from Banking Dive. They basically went in. So what are the 4 things we're looking at here? So obviously M&A. Regional banks like Huntington and PNC dominated the M&A landscape last year as they saw greater scale to take on the nation's biggest lenders. The deal-making gold rush is expected to continue in 2026, but the pool of buyers for smaller banks may shrink, analysts say. That's because the mid-sized lenders that could have scooped up smaller competitors have become acquisition targets themselves. Cadence Bank, for example, bought 6 Texas community banks last year before being acquired by Huntington. That power shift removed 53 billion asset Cadence from the list of potential buyers. So again, we'll just have to keep an eye on M&A, but it looks like that yes, this will be, M&A should continue throughout the rest of the year. I had more on that. I'll discuss that a little bit later. I did a whole episode on M&A at the end of the year, so I'll refer people back to that episode. But like I said, I'll get into that more a little bit later. All right, what's the next one? Chartering. So the 18 de novo charter applications filed with the Office of the Comptroller of the Currency in 2025 marked a return to normal for the agency after years of regulatory dissuasion, according to agency chief Jonathan Gould. Further, the conditional approval of 6 of those applicants served as a harbinger of change. Gould and FDIC Chair Travis Hill have been vocal about their openness to the uptick, and Gould saying it signals healthy competition, a commitment to innovation, and should be encouraging to all of us. So, yes and no. I mean, I think that 18 de novo charter applications, that's nice. I would like to see a touch more. I mean, I'd like to see that number, maybe averaging about 50 a year. I mean, I think that would be a better number, a healthier number. And then when you really dig in to the number of charter applications, the majority of those 18 charter applications actually came from non-bank players. They came from, fintechs, people looking to get into the banking space, people like, PayPal, for example. So again, I think you got to dig into that a little bit. Now, there might be, and somebody might be putting out an episode on this coming up this week. So just maybe keep an eye out for that, where I dig in and I really get into all this. All right, let's keep going. Let's go to AI. So AI tools double their capability roughly every 100 days. So it may make sense to look at the last 3 months of AI-related advancement in banking. In that time, Wells Fargo, Truist, and UBS appointed new execs to oversee AI development. Bank of America hyped the number of AI and machine learning models it's using. Citi stressed that it's not the tech platform that's crucial, but rather how a bank gets its people to embrace AI. And Goldman Sachs wants to completely reimagine processes with AI. That doesn't mean we will have less people, Goldman CEO David Solomon said in October. It means we have an opportunity to have more valuable people doing more valuable things to serve our clients and grow our franchise. Indeed, management consultant McKinsey & Company estimated AI could drive up to 20% in net cost reductions for banks. So again, big thing to keep an eye on this year. And then I think regulations, the last one here. At the nation's financial regulators, the first year of President Donald Trump's second term seemed dominated by the effort to get desired personnel in place. At no agency was that more on display than the Commodity Futures Trading Commission, where all Biden-era commissioners, even the Republican interim chief, voiced their intention to resign before the permanent figurehead was installed. With agencies' top positions secure, year 2 can be about regulation at the CFTC. That will likely mean in-depth forging of digital asset policy. The agencies best set up to advance policy appear to be the ones whose leaders began year 1 effectively in place, like the FDIC, or had previous experience at the regulator when they took the reins, the OCC. By 2025's end, the OCC and the FDIC had made strides toward boosting the number of regulated banks, a stated goal at both. At the Federal Reserve, the biggest question may be whom Trump will nominate as chair, but the central bank's supervision leadership was never in question. Michelle Bowman led an effort in 2025 to demystify stress tests for banks and appears poised this year to make headway on capital requirement standards after an impasse foiled earlier, stricter proposals. So we'll keep an eye on that. All right, and then it goes on. I was looking at this little blurb here on the CFPB. So again, as their efforts to downsize the bureau, either through brute force or funding, have been consistently thwarted in the court for the moment. And that's not the only regulator whose fate may lie in the hands of the judiciary system. The Supreme Court will hear oral arguments on January 21st in Trump's attempted firing of Fed Governor Lisa Cook. The case holds broad implications for the independence of the central bank. Um, Again, I have said this before. I don't believe that anything or anyone should be above the president of the United States. And that's not just a statement, that is for any president that's in there. Um, I don't believe in this myth of the independent central bank. I don't believe in this myth of, the central bank is just this independent entity that just gets to sit over here and do whatever it wants, whenever it wants. I don't believe in that. I don't believe in that myth. I believe that if it's the Federal Reserve and it is part of the federal government, then you answer to the president. Period. End of story. You serve at the pleasure of the president. So if the president wants to fire you, you are gone. Okay, it's as simple as that. That is what I believe in, and I believe that should be true. Like I said, of any president, whether they be Republican or Democrat. I believe that any president, if there's somebody there that they don't like, or somebody there that they think is doing something wrong and they want them removed, they should be able to remove them. And I think that's it, period, end of story. They should be able to remove them. And again, when you block something and you make it so the president does not have the ability to do that, I think you end up in the long run causing a lot of problems. Because again, what happens when you really do have corruption? Because again, when people make stuff like this political, they cut their nose off to spite their face. So what happens? Like, okay, so you sit there and you say, oh, well, we don't want, Trump to be able to fire the Fed governor, Lisa Cook, and they make it a totally political thing, not about the fact that she got caught, with blatant mortgage fraud. Okay. Think about this. A governor on the board of the Federal Reserve got caught doing blatant mortgage fraud. Okay. Sorry, that disqualifies you. You're gone. You're gone. Okay. The insider trading, we had Fed governors that had to resign over insider trading just a few short years ago. And they resigned immediately because they got their hand caught in the cookie jar. But not Lisa Cook, not Lisa Cook. Lisa Cook's going to hang on there till the bitter end. And again, this is a problem because what happens when the shoe's on the other foot, right? What happens when there's a Democratic president in there and the Democratic president goes, oh my gosh, we just caught this Fed governor doing whatever, they got to go. And then people are going to go back to this and be like, oh, no, that Fed governor, they could sit there and do whatever they want. They could stay there. You don't have the ability to fire them because that's what you told President Trump. Okay. And so see, people don't think about that. They don't think about the long-term, consequences or ramifications of messing with some of this stuff. But anyway, all right, that's my soapbox. I get off my soapbox there, whatever. So, okay. So again, 4 things to look out for in 2026. Again, regulation, AI, bank charters, and M&A. So keep an eye on that. Okay. Some big news here. JP Morgan Chase reaches a deal to take over the Apple credit card. So Goldman Sachs is offloading the credit card balances at a more than $1 billion discount. So Goldman Sachs, if everybody remembers, they tried to make kind of this big push into the consumer marketplace a few years back, really made a big splash with saying, hey, we're going to offer the Apple card for Apple. And it just has not worked out well for Goldman Sachs. And this is the equivalent of them throwing the white towel into the boxing ring to basically say that they are done. They are done. The fight's over. We're done. So JP Morgan Chase has reached a deal to take over the Apple credit card program from Goldman Sachs, further cementing JP Morgan's status as a behemoth in the credit card sector and marking the final chapter of Goldman's failed experiment in consumer lending. The biggest bank in the country will become the new issuer of the tech giant's credit card, one of the largest co-branded programs with some $20 billion in balances. The sides which had been negotiating for more than a year, announced the deal Wednesday, confirming an earlier report from the Wall Street Journal. The new deal is expected to bring two of the country's most influential companies closer together, at a time when payments are increasingly playing out on people's phones, watches, and other gadgets. The bank gets a loyal base of Apple customers to whom it can pitch more financial products, and Apple gets a partner with a sprawling consumer franchise to help it sell and finance more gadgets. MasterCard will remain the network on the card, fending off what was steep competition from Visa last year and securing the significant payments volume that comes from the card and its broader partnership with the tech giant. Goldman Sachs is offloading the roughly $20 billion of outstanding card balances at a more than $1 billion discount, according to people familiar with the matter. With most co-brands, balances sell at a premium of up to 8%, a figure that can run into the double digits for the stronger programs. Discounts are rare and are reserved for the most challenged cases. The discount in this deal reflects a high exposure to subprime borrowers and what has been a higher than industry average delinquency rate, creating the potential for significant losses on the outstanding balances. Concerns about those losses slowed the deal talks and contributed to hesitation from JP Morgan and other banks that looked at pursuing a deal, the journal earlier reported. So all is not hunky-dory in this credit card portfolio that, if you will, that is being purchased by JP Morgan. It may look at the moment that JP Morgan is getting a really good deal on this, but we'll see. Time will tell. Time will tell. I mean, it really depends on, you'd really have to dig in to this portfolio to see, okay, how much in subprime is there? What are the real potential for massive delinquency or big time losses on this credit card portfolio? So, but again, somebody out there will have to crunch those numbers and do that analysis to see what they come up with. But and hopefully JP Morgan did. Hopefully they did a little bit better job crunching the numbers on this than they did with Charlie Javis. If you know, you know. Okay, but let's move on here. Okay, so couple things that President Trump is looking to do here, and this is more recent news of all things that kind of went down here within the last week here. So Trump says, and I had been waiting for this. I had been waiting for this, baby. I'm so happy to see this. Trump says the U.S. will ban large investors from buying single-family homes. The American dream is increasingly out of reach for far too many people, especially younger Americans, the president said. President Donald Trump on January 7th announced he's taking steps to bar large investors from purchasing more single-family homes in a bid to offset concerns about inflation and the cost of living. For a very long time, buying and owning a home was considered the pinnacle of the American dream. It was the reward for working hard and doing the right thing, Trump wrote. But now that American dream is increasingly out of reach for far too many people, especially younger Americans. Trump said he would immediately take steps to ban large institutional investors from buying more single-family homes and will recommend that Congress codify his decision, he wrote on Truth Social. In his announcement, the president did not go into detail about what his plan might look like or what companies may be barred from purchasing single-family homes. The move will likely face legal challenges from companies seeking to purchase homes. But obviously, who's he talking about here? He's talking about State Street. He's talking about Blackstone. He's talking about BlackRock. Like this is who he's talking about here, right here. Blackstone is considered the largest private equity owner of U.S. apartments with more than 230,000 units. Let me say that again, 230,000 units, according to data from Private Equity Stakeholder Project as of April 2025. The second largest owner of apartments was Greystar with 138,000 units, and another of other companies own at least 50,000 units each. Again, what is happening here is that these big, companies like BlackRock and State Street, they're coming into a lot of markets around the U.S. and they're paying cash for houses, and they're blocking out would-be home buyers. They're artificially inflating the prices of homes in a lot of markets, and they're getting these massive tax write-offs from these properties. But basically, and basically everything, It bothers me because I'm reminded by that whole slogan from the WEF, you will own nothing and be happy. and not to be that sinister about the whole thing, but if it looks like a duck, it walks like a duck, it quacks like a duck, it's probably a duck. Okay, like when I see BlackRock at State Street, these massive behemoths with these $1 trillion investment companies, when I see them running around buying up all the houses they could get their hands on just with nothing but cash offers because they got a ridiculous amount of cash to spend, that bothers me. That really bothers me because it really looks like they just want to turn us into a nation of renters, and that's not going to work. That's not going to work for anybody in this country. Um, so again, so happy to see President Trump do this. Now, again, I'm sure there's going to be lawsuits are going to fly. BlackRock, Blackstone, all these guys are going to sue and say, oh, he can't tell us, we can't do that, blah blah blah. So I'm sure there'll be fights in the court over this. But again, the problem for these companies is that they are going to have to do some kind of PR campaign. It's like it's not going to be enough to just, like their usual MO would be just to run around Congress and just dole out a lot of money, right? And tell people, oh, no, you're going to vote this way, you're going to vote that. And again, assuredly, they will do that. But the problem is the American people are going to want this. Okay, the American people are going to want this. The American people are going to put a lot of pressure on Congress to make this a reality. And so it is going to be I think, a very difficult fight, despite the fact they go to court, whatever. I think the bottom line is they know what they're doing. They know how they're manipulating the housing market, and it has to stop. It has to stop. So, all right. Got a lot of soapboxes tonight, man. A lot of soapboxes. All right, Trump directs purchase of $200 billion in mortgage bonds. Federal Housing Finance Agency Director Bill Pulte said on X that Fannie Mae and Freddie Mac will execute the purchase. So President Donald Trump on Thursday said the United States will purchase $200 billion in mortgage bonds with the goal of bringing down housing costs. Because I choose not to sell Fannie Mae and Freddie Mac in my first term, it is now worth many times that amount, an absolute fortune, and has $200 billion in cash, Trump wrote in a post on Truth Social. I am instructing my representatives to buy $200 billion in mortgage bonds. This will drive mortgage rates down, monthly payments down, and make the cost of owning a home more affordable, Trump wrote. Federal Housing Finance Agency Director Bill Pulte said on X that Fannie Mae and Freddie Mac will execute the purchase. The announcement comes after Trump on January 7th said he plans on banning large institutional investors from purchasing more single-family homes in an effort to lower housing costs. For a very long time, buying and owning a home was considered the pinnacle of the American dream. Yeah, we heard all that. Over the past decade, private equity firms and investment companies have accrued large portfolios of single-family homes, contributing to high rent costs and increased home prices, according to the Department of Housing and Urban Development Analysis. Furthermore, data from Private Equity Stakeholder Project as of April 2025, again, shows Blackstone with 230,000 units. And let's see here. And okay. But, all right. And I need to talk about this for a second here. So I like this and I don't like it because, President Trump ran on one of the things he ran on was that he was going to take Fannie Mae and Freddie Mac out of the conservatorship that they have been in since 2008, when the government basically took them over during the financial crisis. That was something he said he was going to do in his first term, and he really got blocked on that. And now there was a promise that he made coming into his second term. And now, he's trying to spin it with like, oh, well, hey, I didn't sell it in my first term, and that's great because look at how much it's worth now. No, I don't really like that. I want Fannie and Freddie to be private companies again. And I talked about this at length, at what the real issue is here. The real issue is that Fannie and Freddie generate a lot of profit. They generate a lot of cash. And while Congress has control over them, that is like Congress's personal slush fund. And they take all that money and they blow it on whatever their pet projects are, because that's not a part of appropriations. They didn't have to pass a spending bill to get that money. That money just comes to them every month. And I said that the reason why that Fannie and Freddie couldn't get taken public is because, you know, Congress doesn't want to lose their uber lucrative piggy bank. It's in my mind, it's as simple as that. Now, Trump being very clever here is basically saying, "Oh, okay, yeah, all right, I'm taking Congress, I'm taking your piggy bank away from you because you won't let me, you won't let me, basically take Fannie and Freddie private because you want to control this money, and that's okay. So what I'm going to do is I'm going to take control of the money, and I'm going to take this $200 billion in cash, and I'm going to go buy mortgage bonds with it, which again." That could be a really good thing. That really could help to get interest rates a little bit lower, could help to lower those treasuries, which again, that's a good thing. My issue is that the same issue though remains of the government once again using their private piggy bank of Fannie and Freddie to fund again another, in a way, pet project. This is, and again, this is why I said, like, this has got to stop. Like, this is why we need Fannie and Freddie to be sold, to be private companies again, to get them out of the hands of Congress and out of the hands of the government, so that people can't just be doing stuff like this all the time. Like, this is so again, I like it, but I don't like it because again, I see where this is going, and it's just more proof that that we're never going to be able to get, like, we're never going to be able to get Fannie and Freddie out of this conservatorship. They're going to sit there for the next 100 years because because like I said, they generate a lot of money, which can be used for all this kind of stuff. So anyway, all right. Here's another thing. Now, this is not necessarily a banking related issue, but this is more of a general economic issue here. So Trump proposes increasing military spending by 66% with a $1.5 trillion 2027 budget. Democrats and Republican deficit hawks will likely raise objections to the defense spending increase. Maybe one or two will, but most of them won't. Most of them will love it. I guarantee you most of them love this. Most of them are like, what? You want to spend more money? Fantastic. Let's go. Let's do it. Oh, you want to spend it on defense contractors? Even better. Let's go, baby. Let's go. Dole that money out. Here's my problem. By increasing the defense, I mean, we already spend almost $1 trillion on defense spending. How much is enough? Like, you're seriously telling me that $1 trillion is not enough to get the job done? When you look at, I think the next closest country to the U.S. in terms of defense spending is China, and China spends they spend a minuscule amount of money. I think they spend 150, $200 billion on defense. After you get past China, it drops off a cliff. I mean, a lot of these other countries are spending 10 billion, 30 billion, 50 billion a year on defense. That's part of the reason why Europe, like when you see England and France and Germany talking about, well, they're beating their chest. We'll put an army into Ukraine. We'll put our army into Ukraine. They don't, guys, I got news for you. They got no armies. They have no armies. They haven't spent money on armies in 80 years. Okay, there's no money there, and they're all broke. By the way, all three of those countries are broke. Germany's falling apart. France can't pass a budget. France can't even get a government coalition together. The UK is a hot mess. All three of those countries are a hot mess. This idea that magically overnight that they're going to increase all this defense spending and put these militaries back together and send them over to Ukraine to fight it's a joke. It's a bad joke. But again, my point being is, you're telling me that $1 trillion is not enough. And here's the other thing, that is not going to bring any of these numbers down. The U.S. national deficit, the U.S. federal budget deficit, those numbers aren't coming down. They're going to go up if you increase this defense spending to $1.5 trillion. I have a really, really hard time with this one. The other thing is, with all of the fraud shenanigans that we're seeing right now in Minnesota, and undoubtedly going to expand to other parts of the country, you're seriously going to sit there and tell me that in that $1 trillion in spending, you're going to tell me there's no fraud in there? You're going to tell me that all that money is accounted for and totally legit? I don't think so. I don't think so. And as a matter of fact, I'm going to show you something else here real quick. Oh, what's this? The Pentagon failed their audit for an eighth consecutive year? You call me shocked. The Department of Defense aims to pass a clean audit in 2028. They're pushing it off another 3 years. 3 years. 2028. Pentagon fails audit for eighth consecutive year. I mean, what a joke. What a joke. They can't pass an audit. So, and you're going to tell me they know where this $1 trillion is going, but yet at the same time, we're supposed to jump on board this train to increase their budget by another $500 billion up to 1.5 trillion. Like, man, I have a really, really hard time with this one. Now, hey, look, I will say this in the vein of patriotism, in the vein of wanting my country to remain on top. If you make a good case to me that there's a reason why we need this money, like in other words, if we just took out the dictator in Venezuela, that's awesome. I actually love it. That's, to me, that's the kind of stuff that the U.S. government should be doing. Okay, if you're going to tell me that you're going to go clean out Colombia and clean out Brazil and clean out Cuba, take control of Greenland to basically have hemispheric dominance. Okay, to make sure that we truly have free countries in our hemisphere. I could be down with that. I could buy, you could sway me with that argument if that's what you're going to do with the money. But I don't know that that's what they're going to do with the money. I surely don't want it to, go over and build a whole bunch of military bases over in Asia and basically try to, protect Taiwan, even though I understand how strategically important Taiwan is. Yeah, I don't know. Again, that's just one of those things where this is really tough for me to swallow this one. It really is. I would be more inclined to say, hey, listen, why don't you take Doge over there to the Pentagon, and why don't you let Doge root around? Because I'd be willing to bet that Doge could find 100, 200 billion of waste, fraud, and abuse over there at the Pentagon. I think they could easily find that. Okay, and then let's clean that up a little bit, and then maybe you don't need 1.5 trillion. Maybe you only need 1.2 or 1.25. Maybe we could bring that number down a little bit. Just a thought, just saying. So, all right, let's keep rolling here. So, U.S. Treasury implementing Trump-backed no tax on car loan interest, Besant says. So the guidance said that new vehicles eligible for the tax deduction include those with final assembly in the United States. So the Treasury Department is implementing a policy that eliminates taxes on car loan interest. A move meant to lower costs, Treasury Secretary Scott Bessent said on January 7th. The policy, which the secretary called no tax on American car loan interest, is being implemented under the Trump administration-backed One Big Beautiful Bill Act, signed into law last summer. The tax cut will be putting money back into the pockets of working and middle-class families. For new U.S. assembled vehicles purchased in 2025 through 2028, eligible taxpayers can deduct up to $10,000 per year in auto loan interest, whether they itemize or take the standard deduction. This deduction helps lower monthly costs and makes car ownership more affordable when families need it the most. So I will tell you, because I have looked into this a little bit, there are cutoffs. Just with like no tax on tips, just with all the other things that they kind of put out there, there are cutoffs on this. So I believe it's around $100,000. Like if you make over $100,000 a year, you can't take this deduction. You're out. So this is really targeting people who make $60,000, $70,000, $80,000 a year, which I think is it's good, but it's not going to have the impact that they want. I do not believe it's going to have the impact that they wanted it to have. And what do I mean by that? Well, if you're making $70,000 or $80,000 a year, you're not buying a truck or something that's going to cost you $10,000 a year or up to $10,000 a year in loan interest. you're just, yeah, you're, yeah, you might buy a car. It might cost you 3,000 a year. You might spend $3,000 a year in loan interest, or maybe 4, but you're not spending upwards of 10. And I think that if they had increased that just up to, because I think it's like married couples might be, what's joint? I'd have to look it up again. I think joint might be like 160 or 180, something like that. And joint income, I think you get kicked out of being able to deduct the $10,000. But I think if they would have made that more like 250 or 300,000, I think it would have had a much bigger impact. I think it would have helped. It would have definitely helped a lot more Americans, you know. But again, I don't mean to knock it though. Hey, look, every little bit helps. I think it is a very good thing. I think it's going to help a lot of people out there. I think a lot of people are going to be really tickled to death that they're going to go out and buy a new car this year, and they're going to get to, or maybe they bought a car last year, and they're going to get to write that interest off on their tax return. So that's a good thing. So okay. House passes 3-year extension of Obamacare subsidies. So 17 Republicans joined 213 Democrats in favor of the bill, which faces long odds in the Senate. Yeah, again, this gets back. I don't really report on this so much because of the health care. I report on it because of the spending. Again, it gets back to the spending, and it just shows you, like I said at the beginning, they do not have an appetite on Capitol Hill to cut spending. 17 Republicans. I mean, that's a joke that 17 Republicans would vote for this. I mean, it is. And it's a 3-year extension. Let's just kick the can down the road. Let's just keep the ridiculous spending going. It's just crazy. It's just crazy. And again, I'm not going to get into all the nuances of this, and I don't know what will happen with this in the Senate. I don't know if the Senate Republicans will cave and will vote for it, or if there actually will be some pushback on it. I don't know, but we'll see. We'll see what happens. Trump plans to discuss potential price cuts with health insurers. The president said the meeting could take place in Florida in the coming weeks or at the White House in the first week of 2026. As of yet, I don't think that this has really happened. But President Donald Trump said on December 19th that he plans to hold a meeting with health insurance companies to discuss potential price cuts as he seeks to reduce healthcare costs for U.S. consumers. I think that the insurance companies, we should have a meeting. We should talk to them, Trump told reporters during the White House event, because I would say that maybe with one talk, they would be willing to cut their prices by 50, 60, or 70% because they have made a fortune. Trump said the meeting could take place in Florida in the coming weeks or at the White House in the first week of 2026. Or if the insurance companies have anything to say about it, never. All of the billions and billions, ultimately trillions and trillions of dollars. I have his voice in my head as he's saying that, the billions and billions, the trillions and trillions. These companies were going to pay directly to the people. But there's another way of doing it, and that's getting the insurance companies to ease up and to cut their pricing way, way down and stay part of the system. So, all right, well, again, we'll keep an eye on that, and we'll see if anything comes of that. So, Trump announces $1.3 billion in sales of gold card visas. So the proceeds are going toward paying down the national debt. Well, I hate to break it to everybody, but 1.3 billion paying towards a national debt of 38.5 trillion. That doesn't equate to a speck of sand in the Sahara, as they would say. Okay, in terms of paying down the national debt. So like, okay, that's nice. Again, this is one of those things that falls into the realm of, I think it's a good idea. I think it will make the U.S. I think it will generate, some good money for us. A few $1 billion is nothing to sneeze at. But the idea that, like, oh yeah, this is going to get put towards the national debt, and this is really going to make a dent or really going to change anything. Like, no, it won't. Okay, Argentina repays 20 billion U.S. swap line. Scott Besson says, so support for Argentina's Javier Milei was America First home run deal, says Treasury Secretary Scott Besson. So obviously, if we remember from, what was that, like a month and a half ago, Javier Milei was in some trouble down there in Argentina. He needed some money. We extended him basically a line of credit with a swap line. And basically, of course, Democrats went nuts and said, "Oh, this is a bailout. What are you doing? You're just giving them all this money." But as it turns out, this actually worked out pretty good. So Treasury Secretary Scott Bessent said on January 9th that Argentina has repaid a drawdown on the $120 billion swap line with the United States. A severe October 2025 cash crunch pushed Argentina to obtain a $20 billion backstop from the Trump administration, delivered through a currency swap facility that shored up the peso. So it is unclear how much the Argentina government used from the swap line. 3 months later, after employing a peace through economic strength policy, the United States no longer held pesos and generated a profit from the agreement. Stabilizing a strong American ally and making tens of millions of dollars in profit for the Americans is an American first home run deal. Setting the course for Latin America, a strong and stable Argentina that helps anchor a prosperous Western Hemisphere is in our clear best interest. So okay, that's again good news there. All right, I'll tell you what. Before I get into these because I have about 5 auto articles here that I wanted to share with everybody. I want to switch gears here for a moment. And I want to give you guys the economic indicators for this week. I also want to go over the 150 episodes I put not that many over the last 3 weeks, but we'll get there. All right. Tell you what, let's do economic indicators first. So let's jump in here. Okay, economic indicators. So for this week, Monday, January 12th, we get the 10-year Treasury note auction, the 3-year Treasury note auction. On Tuesday, January 13th, we get the ADP Employment Change Weekly, the core CPI, new home sales, the 30-year bond auction, federal budget balance, and the API weekly crude oil stock. On Wednesday, January 14th, the core PPI, core retail sales, PPI for November, retail sales, existing home sales, Atlanta Fed GDP now, and the beige book at 2 p.m. On Thursday, January 16th, we get import price index, continuing jobless claims, initial jobless claims, Philadelphia Fed manufacturing index, New York Empire State manufacturing index, manufacturing PMI. And then finally, on Friday, January 16th, we get the industrial production and the U.S. Baker Hughes total rig count. So it's a beautiful thing having all these economic indicators back again. I love it. Gives me some good stuff to talk about right here on on the podcast. So love having all these economic indicators back. And we've got a lot of stuff coming out this week. A lot of inflation data, retail sales number, manufacturing indexes. So a lot of good stuff coming out this week. So, all right. Let's shift gears here. And I'm going to try to blow through some of this as quick as I can, because I think I had about 17 episodes here over the last couple of weeks. So first up, I actually thought this was kind of funny. So the first episode I did 3 weeks ago was, how did economists get President Trump's tariffs so wrong? And so this episode basically said, when President Donald Trump declared Liberation Day back in April, economists were quick to predict that increased tariffs would wreck the economy, leading to a recession, increased inflation, and increased unemployment. 8 months later, tariff revenue is flowing in, GDP is strong, inflation has held steady, and the employment market is okay. The world has not ended. So why did economists get it so wrong? Now, I am going to show you guys one thing here. Let's go to X for a second. And let's go back. Where's my boy here? I'm going to find this here for a second. Hold on. Bear with me for a second. I'm getting there. Oh, no. Did this go all wonky on me? I hate when it does that. I hate when it scrambles this around. I had the clip of the guy on CNBC basically saying that he basically admitted that, like, oh yeah, nope, Trump was right. Basically, yeah, now it's just flying all over the place there. So, all right, so let's go back to this for a second. All right, so basically, a lot of people did not like this episode. I was really shocked, man. I think there are a lot of just I thought that I had really just kind of called balls and strikes with this one. I really tried to just call it right down the middle. Um, Again, just looking at it from a purely economic standpoint, like did it work? Did it not work? Like what the deal is? I talked about a paper that the Federal Reserve had just done. San Francisco Federal Reserve had just done on in looking at tariffs. But yeah, a lot of people did not like this episode. I got a lot of thumbs down. Got ratioed, as it were. So, which I actually thought was kind of funny. I looked at some of the comments too on the video. Again, I thought there were some pretty funny comments coming from some of the people on there. But yeah. So like I said, I thought it was a really good episode. I thought that people would really like it. Not so much, but whatever. It is what it is. Okay. Then I did major high frequency trading firms are now battling over milliseconds. So, Mosaic, a French high-speed trading firm, recently complained to Eurex and European regulators about other high-speed trading firms using a method in which they bombarded an exchange with useless data. This maneuver buys them enough time to react fractionally faster to market-moving information. This move is apparently making certain high-speed trading firms a lot of money. Again, I thought a very interesting topic, looking again at what we would describe as more the plumbing of the stock market. So, which I thought was a good thing. And then this next episode was a very, very important episode. The medical industry price fixing lawsuit that could change everything. So over 20 plus healthcare groups from all over the country have joined with a large number of plaintiffs in a lawsuit against every major health insurance company in America. The lawsuit alleges that the health insurance companies use software from a company called Claritev to create a price-fixing environment that allowed them to siphon billions of dollars from care providers and their patients. The stakes could not be higher for the health insurance companies, as they could stand to lose billions and see major changes to how out-of-network care is priced and reimbursed for patients in private insurance. So again, that is just a major, major deal. And it'll be fascinating to see what the court decides on that, how that comes down. If in fact they basically say that, yeah, that third party company with the third party software did help those insurance companies basically create a price fixing scheme. I mean, man, the damages to those health insurance companies could be monumental. So again, we'll have to keep on that one. Now, for Christmas Day, I did a special episode. I did what I called Parables of the Rich, a BND Christmas read along. So basically, I tried to do something a little bit different for Christmas Day. So I basically read three parables out of the Gospel of Luke about the plight of the rich. These included the rich fool, the rich man, Lazarus, and the rich official. So again, I thought, something a little different there for Christmas Day. Then I did the decline in bank branches. A decline in bank branch closures hits a 14-year low. So the number of U.S. banks closing branches has hit a 14-year low, according to research from S&P Global. The number of bank branches being closed is still outpacing new branches being opened, but the margin has been shrinking over the last 4 years. So again, I thought important episode, very interesting about what was happening with bank branches in the U.S. And then I did update on commercial real estate at year end 2025. How is commercial real estate performing at year end? We take a look at CRE reserves, delinquencies, how some banks are feeling about their CRE portfolio. Overall reserves for loan loss allowances are holding steady. CRE loan delinquencies have decreased for 2 consecutive quarters. M&T Bank is feeling pretty good about having a little CRE growth in 2025, while PNC still sees a little contraction ahead. So again, kind of the year-end update on commercial real estate. Then the next week, I went to final thoughts on bank M&A for 2025. So bank M&A activity cooled down in the fourth quarter of 2025. Still, 2025 had generated 165 bank M&A transactions year to date. This is the largest number of bank M&A transactions since 2021. Not only that, the total deal value, assets sold, deposits sold, and median deal value to tangible common equity were also the best since 2021. So that was kind of my year-end recap on M&A. Then I did how the U.S. labor market changed in 2025. So the U.S. labor market went on a very interesting ride throughout 2025. This episode reviewed many of the main headlines, which included more Americans find only part-time work, future for low hire, low fire, U.S. labor status wobbles amid mixed signals, AI eliminating entry-level tech jobs, high unemployment for young workers, labor force participation for youngest male U.S. workers plummets, soaring number of Americans face long-term joblessness, and job growth concentration in health and hospitality. So again, just looking at a lot of different factors and variables of the labor market, and kind of just, again, doing kind of like a year-end recap there on that. Then I did for New Year's Day, I did 2025 year in review, where I covered a couple blog posts from PCBB, where basically looking at regulatory shifts, M&A, strategic partnerships, digital transformation, payments innovation, cybersecurity, and data privacy, interest rates, margin pressure. So went over a number of kind of the biggest trends in banking during 2025 in that episode. So if you want a quick kind of recap of the year, go look at that. And then I did a look back at 2025 and what is ahead for 2026. So that was my recap for the channel itself. So I did a year in review recap of basically 2025 for the banking business and for financial services, the economy. I did that, but then I did another look back at 2025 and a look ahead for 2026 for the channel. And I talked about, what were the 10 top BND episodes for 2025? What was the most viewed interview for 2025? What was the most watched playlist for 2025? This episode is kind of the best of BND for 2025. And then I talked about just some things that I'm working on for 2026, some things to come here in the near future. So you guys could check that episode out. It's a short episode. It's only like 7 minutes, 8 minutes. So you guys, like I say, you could go check that out if you want to get a little bit more insight into what's happening on the channel. Next, I did update on private credit as Tricolor executives are charged with fraud. So as Tricolor Holdings executives have been charged with systemic fraud, auto lending continues to deteriorate, and bank regulators are vowing to take a closer look at what's called NDFIs, non-depository financial institutions. So U.S. prosecutors in Manhattan unsealed indictments against founder and CEO Daniel Chu and Chief Operating Officer David Goodgame. The charges accused the two executives of orchestrating a series of fraudulent schemes that allowed Tricolor Holdings to obtain billions of dollars from lenders by misrepresenting the value of its loan collateral. Bank auto loan delinquency increased to 2.9%. Credit union auto loan delinquency increased to 2.5%. So again, following a lot of the episodes that I've already done on private credit, the private credit market, subprime auto business. So again, just kind of another update there at the year end to let people know what was happening with that. Then I wrapped up that week. Last episode for that week was what makes a great mobile banking app. So, and I thought this was a very interesting one because it said, what makes a mobile banking app something that customers get excited about? So this episode looks at 5 capabilities that a bank should consider. 1, simple and seamless design. 2, real-time alerts. 3, predictive insights. 4, hyper personalization. And 5, easy customer service. So according to McKinsey, mobile banking leaders generate 51% more annual touch points and 2.3 times as many customer interactions. So again, I thought that was a great topic to kind of start 2026 off with, and something that people would really get into, because I really do think it's a good topic there. So all right, let me switch over. Got to switch to another sheet here for a second. Okay. What did I have, I believe, for this week? So the first episode I did of the week was the Fed makes a massive year-end repo injection, liquidity problems or window dressing. That's the big question, right? So on December 31st, 2025, the Federal Reserve made a massive 74.6 billion securities purchase in the repo market. This also coincided with mortgage-based securities purchases, treasuries security purchases, a surge in SOFR volume, and an increase in the Fed's balance sheet. The big question here, is this a sign of major market liquidity issues issues or just year-end window dressing. So that was the episode I had on Monday. A lot of people, unlike the tariff episode, a lot of people really liked that episode, got a lot of positive feedback on that one. And again, just something that we're going to follow, definitely through. It's going to be an issue that's going to play itself out through most of 2026 here. Then I did silver market is on fire, supply shortage or market manipulation. So heading into Monday, December 29th, silver futures witnessed one of the largest plunges it has seen in 5 years. This plunge came on the heels of silver futures making a massive run up to over $80 an ounce. A wild story began to circulate about one of the largest banks in the country receiving a margin call so large that it was going to wipe out all of its liquidity. This story turned out to be false, mostly, but not entirely. You have to watch the episode to get all that. But again, what happened there in the silver market at the end of the year was really fascinating. So definitely, check that episode out when you get a second. So then I did my next installment of the Crypto Series Part 32. So which was called Crypto Accounting, North Korean Bankers, and a Year-End Hangover. So basically in this episode, we covered FASB weighing whether some stablecoins may qualify as cash equivalents in 2026. JP Morgan is getting further into crypto with a tokenized money fund called On My Chain Net Yield Fund, or Money. The fund will only be open to qualified investors with at least $5 million in investments. Crypto investors were loving most of 2025 as the president embraced crypto. There was a shift in tone from regulators. Congress passed crypto regulation, but then the end of the year came. Crypto slumped across the finish line with a negative return for the year. So that was the Crypto Series episode, part 32. Then I posted out on Thursday, what is hot in private equity and what are they doing in 2026? So there is a boom in deal making right now in the wealth management business. This is due to private equity firms buying up smaller firms. Private equity is also focused on other industries, including veterinarians and dentists. However, private equity is dealing with a few issues going into 2026. First, they are sitting on a large pile of cash, approximately $880 billion. Second, the average holding period is still pushing up against their industry high at 7 years. Third, the number of companies sitting in private equity portfolios is at a 15-year high of approximately 12,900. The industry is hoping that M&A and IPOs pick up in 2026, which will help pick up activity and reduce all these issues. But again, I thought it was a timely review there on private equity for the end of the year. And then finally, yesterday's episode I put out was Warren Buffett is gone, and this marks the end of an era at Berkshire Hathaway. So Warren Buffett has stepped down as CEO at Berkshire Hathaway after a 6-decade run. Warren will remain chairman, but he has turned over all day-to-day operations to Greg Abel. There will never be another Warren Buffett, never. The return generated by Berkshire from 1964 to 2024 was nothing short of insane. During this period, the compound annual gain was 19.9%, nearly double the S&P 500's return of 10.4%. This resulted in an overall return of more than 5.5 million%. Let me say that again. This resulted in an overall return of more than 5.5 million%. In the mid-1960s, Berkshire's shares traded around $19. By the end of 2025, a single Class A share was worth over $750,000. Okay, $19 in 1964, $750,000 in 2025. And Warren believes that basically Berkshire is being left in great hands. It can last another 100 years. One of the biggest questions now for the new CEO is how will he invest the massive $358 billion cash pile sitting on Berkshire's balance sheet? But again, I wanted to show that because that is history. That is a monumental event. I just don't think we will ever see another Warren Buffett. I don't think we'll ever see that. His longevity, being able to be, how many people are going to work till they're 95 years old? How many people would be able to run a company like that until they're into their much till 80, much less 90 or 95? I just don't think, and not only the longevity, but the continued track record, the continued excellence. the continued, kind of nonstop growth of the company. He did it. He did. This wasn't like a private equity or a hedge fund. He used basically like a holding company type setup to do his investments and buy other companies. And it's just and that's just a very rare thing. You don't see many people out there trying to do it that way. So again, for a lot of reasons, I don't think that we will ever see another, Warren Buffett. I don't think we will ever see that. So again, those were the episodes that I had that came out basically over the last 3 weeks. So even though I wasn't doing the live stream, it was still a very busy 3 weeks there of things going on. Okay, now, as I typically do right around this time, I have banking news for everybody. So kind of everything I do is banking news. This is not, it's just, but this is kind of like paper banking news, maybe obscure banking news would be a better word for it. All right. Here we go. My little stack here. ICBA supports pro-community bank legislation at Capitol Hill kickoff. So introduced this week by Committee Chairman French Hill and Subcommittee on Financial Institutions Chairman Andy Barr, the Main Street Capital Access Act, HR 6955, includes ICBA-supported provisions to tailor regulations to the lower risk profile of community banks, ease excessive capital requirements to support the formation of new community banks, ensure fair reviews of agency examinations, raise thresholds for holding, custodial, and reciprocal deposits, and more. So this could be a huge one. Big deal for community banks out there with this legislation, and we'll keep an eye on that one and see what happens. OCC proposes expanding national trust bank activities. The OCC proposed a rule to allow national banks to engage in non-fiduciary activities in addition to their fiduciary activities. Fed to resume taking pennies at coin distribution locations next week. So the Federal Reserve announced it will resume accepting pennies from banks at commercial coin distribution locations beginning this week on January 14th. So I think that was a good move on their part. The penny issue was becoming a little bit of an issue, and I think them starting to reaccept it for the moment, I think that's a good thing. ICBA engages digital asset expert. So ICBA announced an agreement designed to help community banks succeed in the digital assets marketplace. ICBA announced a consulting agreement with Wade Peary, longtime community bank executive and digital assets expert, as part of its commitment to advocacy, education, and innovation in community banking. So somebody might be doing an interview with Wade. I'm not saying who, but somebody might have. There might be an interview with Wade coming up in the not too distant future, so maybe keep an eye out for that. House Republicans unveil pro-community bank legislation. So House Financial Services Committee Chairman French Hill and Andy Barr, again, the Main Street Capital Access Act, looking at doing a whole bunch of things. And this is a little bit more, I should have read this one first. This was a little bit more detailed review. So tailored regulations to the lower risk profile of community banks, ease excessive capital requirements, support the formation of new community banks, ensure fair reviews of agency examinations, raise the thresholds for holding custodial and reciprocal deposits, require the appointment of an FDIC board member with experience in small depository institutions. I love that. That's kind of like what the Fed did with Michelle Bowman, putting somebody who was there to support community banks. Modernize the Federal Reserve's discount window lending programs. Love that. That's a great one. Offer relief at the holding company level. Great one. Love that. Promote fintech partnerships. Yes, I think that's a good one. All really good stuff there. Fed's Michelle Bowman says more regulatory relief is on the way. So again, I think she was just kind of touting this law and basically saying that, hey, we're going to continue to work on right sizing regulation. CFPB amends Reg C exemption threshold. They also amended the Reg Z creditor exemption threshold as well. I could get into that, but then everybody would be asleep by the time I was done. FHA insures 876,000 mortgages in 2025. So the Federal Housing Administration reported it insured 876,502 mortgages in 2025, representing $274 billion in original unpaid principal balance. So there you go. So manufacturing activity contracts in December to a little bit, but not too much. A new article spotlights accelerating credit union acquisition. So once rare credit union acquisition of community banks are becoming routine and a defining feature of consolidation in U.S. finance, according to a new article. Yes, I mean, I've reported on that many times, but yes, we continue to see more purchases of banks by credit unions. Again, it gets to a whole issue there. Home prices increased in October. The FHFA data, average monthly mortgage payment is now $1,985 a month. So that is the average monthly mortgage payment in the United States. FDIC provides update on resolution planning for large banks. Fed officials mixed on future rate cuts. Yeah, we talked about that. FDIC updates their website with information on failing financial institutions. So the FDIC announced it has enhanced the information on failing financial institutions available on its website. You know, I meant to show that to you guys, but maybe I'll save that for next. I'll come back and show you the website and go through and point some of those things out. So ICBA to agencies, proposal should ensure consistent and fair supervision. So the ICBA signals support for a proposed rule regarding unsafe or unsound practices and matters requiring attention, but it called on regulators to ensure supervision is consistent across the banking agencies. So consumer sentiment edged up in December. Existing home sales increased in November. Bank trading revenue increased in the third quarter. Fed report, debit card transaction fraud is growing. The Federal Reserve published its biennial report on debit card transactions, which summarized information collected from Durbin-covered debit card issues and payment card networks. The FHFA reports decline in single-family guarantees in their annual report. FHFA enterprise mortgages see more delinquency in the third quarter. Durable goods orders down in October. Industrial production increases in November. Consumer confidence declined in December. Let's see here. FHFA releases affordable housing goals for Fannie and Freddie. Agencies adjust CRA asset threshold. Treasury publishes penny frequently asked questions. So the Treasury Department published non-binding guidance for businesses and consumers on handling various penny situations. Summary reveals record numbers for community banks in 2025. OCC proposes preempting state laws on escrow interest. OCC proposes raising threshold for heightened standards. ICBA supports proposal to bar agency use of reputational risk. So ICBA expressed support for a proposed rule to prohibit the use of reputation risk by regulatory agencies and urged the agencies to finalize it promptly. Okay. House Republicans push Fed for new approach on pennies. Yeah, let's hope something comes out with that. Fed seeks input on limited purpose payment accounts. So the Federal Reserve requested public comment on proposed payment accounts which eligible financial institutions could use for the limited purpose of clearing and settling their payments on Federal Reserve payment services such as FedNow and FedWire. Senate confirms Hill as FDIC chairman. And then President Trump signs executive order to facilitate cannabis research. So President Donald Trump signed an executive order designed to expand research into medical marijuana and cannabis. So, all right. Man. And again, sorry, guys, that was 3 weeks worth of stuff that had gotten backed up there. So it took a little while to get through all that. So, all right. Let's get back to all the articles, shall we? So let's get back to where did we leave off here with the auto stuff. So, all right. I just wanted to roll through this real quick. I still have a little bit of, we're going to talk a little bit about for the remaining 30 minutes or so here. Still going to talk about some economic indicators. I got a little bit of tariff information. I got a little bit of commercial real estate stuff we're going to talk about, mortgage interest rates, and then some. I'll wrap it up. I got 4 or 5 articles on just some general banking news of just things happening. So, all right. So GM Toyota hint at tougher year ahead for U.S. auto sales. So sales are expected to slow after 3 years of gains as consumers push back on rising prices. So General Motors and several rivals reported year-end sales slumps, an ominous sign that U.S. auto sales will slow this year as consumers push back on higher prices. GM, the biggest automaker in the U.S. by sales and a bellwether for the U.S. industry, said Monday that sales fell 7% in the final quarter of 2025. Honda, Hyundai, Mazda, and Nissan also said on Monday that their U.S. sales fell toward the end of the year. The slowdown is expected to extend into this year. Analysts and automakers predict U.S. annual sales will fall in 2026 following 3 straight years of gains as belt-tightening American car buyers collide with tariff costs that companies probably won't keep absorbing. Well, we will see. Executives at Toyota, which notched an 8% increase in U.S. sales during the fourth quarter, said they are preparing for a bruising year ahead. Toyota was able to maintain sales momentum at the end of last year by absorbing the cost of U.S. tariffs and because car buyers gravitated toward the company's entry-level models like the Corolla sedan. Yet executives said companies won't be able to keep footing the bill for tariffs. Prices are going to go up for us and for our competitors. Well, I would just say this, if they want the tariffs to go to zero, what do they have to do? All they have to do is build the car in America. Then they don't have to pay any tariffs. So, kind of an easy answer there, right? Now, when they say that the consumer is, getting bruised up there and putting pushback on the cost, maybe this has something to do with it. Car payments now average more than $750 a month. Enter the 100-month car loan. 100 months car loan. Yeah, that's crazy. Yeah, 100-month car loan. That's nuts. That's basically what, 8 years? 7 years would be 84 months. 96 months would be 8 years. So that's a little over 8 years. Like 8 years and 4 months, whatever. Or no. Wait, now. Yeah, about that. Yeah, about 8 years and 4 months. This fall, typical new car broke the $50,000 barriers. We don't have $300 monthly payments any longer. The cost of vehicles has just gotten out of sight, man. The price of new cars and trucks in the U.S. has increased 33% since 2020, and consumers are piling on interest as they stretch out loan terms to 8, 9, and nearly 10 years. David Keller, who runs a Dodge and Jeep dealership in Glen Mills, PA, 27 miles west of Philadelphia, said many American families can't comfortably take on a new car payment these days. We don't have $300 monthly payments any longer on new vehicles, he said. It's a thing of the past. Yeah, I would say the average new car payment might be $760, but in reality, a lot of these vehicles that you're buying, if you're trying to finance them for 5 years, 6 years, maybe even 7 years, they're costing you over $1,000. These are $1,000 a month car payments, not $750, $1,000. And depending on what you're buying, what kind of, if you're buying an F-150, a Ram, Dodge, some of the Jeeps. And this is just, this is just a huge problem. I ask myself all the time, like, who is, how many people can afford to buy a lot? I mean, again, you see the trucks and the SUVs and everything out all over the place. And it's like how, if you're buying one of these things brand new at 70, 80, 85, $90,000, like what, I just keep kicking around, like how many people can afford that? For a lot of people, this may sound nuts, but for a lot of people out there, that car payment might be more than their mortgage. If they got a mortgage payment that's $1,000 a month and they got a car payment that's $1,200 or $1,300 a month, like that, I mean, that's nuts. But anyway, I digress. So, all right. So Ford reported the best annual U.S. vehicle sales since 2019. So while things slowed at the end of the year, Ford did have a pretty darn good year last year. So Ford Motor on Tuesday said its U.S. vehicle sales last year increased 6%, making the company's best annual sales since 2019. The Detroit automaker reported sales of 2.2 million vehicles in 2025, including a 2.7% uptick to more than 545,000 units during the fourth quarter. Let's take a look at GM. GM posted a 5.5% U.S. sales gain in 2025. Stellantis' Jeep marks the first increase in 7 years. So General Motors on Monday reported a 5.5% increase in its annual U.S. sales in 2025, despite a 6.9 decrease during the fourth quarter. The Detroit automaker retained its position as the largest seller of vehicles in the U.S. Stellantis, meanwhile, reported sales were down 3.3%, but its Jeep brand posted a gain for the first time since 2018. So again, little bit of mixed signals here, as you know, these companies have had, the automakers have had some pretty good years for the last 3 or 4 or 5 years. Again, they're expecting 2026 to be a little bit of a lull or a downturn. We'll see. We'll see. We'll see what happens. We'll see what happens there. And then finally, on the vehicle front, used vehicle pricing expected to increase 2% in 2026, a historically stable rate. So prices on used vehicles are expected to rise this year, but at a historically stable rate, according to auto data and insights from Cox Automotive. Wholesale prices on the Manheim Used Vehicle Value Index will end this year 2% higher than December of 2025. The average index move at the end of the year is an increase of roughly 2%. So again, I think that's really good, because we were seeing used car prices increase by as much as 20 and 25% at different periods throughout the last 5 years. So I think, only seeing an increase of 2%, that's pretty good. I would take that. I would definitely take that, Yes, like here's the used vehicle index here. Like I said here, December of 2021, we were up to 25. Or wait, no, I'm reading that wrong there. 257.7. All right, that's not a good index of what I was looking for there. But again, it basically just talking about the how much the value of used cars went up. It spiked really high 2021, 2022, came down a little bit more over 23, 24, and 25. But we saw, like I said, only looking for a 2% increase in 2026. And again, what they would call a very historically stable rate, which like I said, I would take it. That's not too bad. So, all right, moving on here. Let's talk about commercial real estate for a minute, shall we? So Americans are changing where they're moving. Here's how that could affect commercial real estate. So Americans are increasingly moving to smaller markets rather than urban cores as they seek cheaper housing and a better quality of life. Oregon was the most popular moving destination for the first time ever in 2025. So while Florida and Texas are seeing more balanced migration, according to an annual migration report from United Van Lines, the commercial real estate market will also have to shift to adapt to those changes, experts say. So historically, Americans moved in order to find better economic opportunities, but the driver has now shifted from the go west, young man mentality, where free and open land presented that opportunity, to much more personal incentives of family and affordability, according to an annual migration report from United Van Lines. It found Americans are not only choosing to live closer to family, but that they want smaller markets rather than urban cores as they seek cheaper housing and better quality of life. This shift will have a significant impact on commercial real estate investors and the choices they make going forward. Oregon was the most popular moving destination for the first time ever in 2025, while Florida and Texas, which had seen huge influxes in the COVID and early post-COVID years, are now seeing more balanced migration. 6 of the top 10 inbound states were in the South and South Atlantic. So West Virginia, South Carolina, North Carolina, Arkansas, Alabama, and Delaware. Delaware? Delaware? Really? Delaware? I don't know about that one. The data reveals Americans are seeking a different pace of life, and destinations like Oregon, the Carolinas, and the South are delivering it. Eli Cummings, Vice President of Corporate Communications at United Van Lines, said in a release, while our total number of residential moves is similar to 2024, we're seeing much greater complexity in why people move and increasingly divergent migration patterns across age groups. Younger millennials and Gen Z are favoring New Jersey, meanwhile, since it's more affordable than New York City, but retirees are moving out of the state, making it the top state for outbound migration, according to the report. So again, I think this is really interesting stuff here on, kind of where people are going. And this, again, these patterns are not new. They've been out there for the last, 3 or 4 years. But again, this will have an effect overall on commercial real estate. People that have their business, you're gonna move your business to another community. Do they have the buildings there that you need? Do they have a space that you need? Do they have offices, retail, industrial? These are all, big questions to ask. So here's an interesting article. The condo market hasn't been this bad in over a decade. Condo prices this fall posted their biggest declines since 2012, hit by rising homeowner association dues and weaker demand. Um, Condo owners are struggling with the worst market in more than 10 years. Prices for U.S. condominiums posted their biggest annual decline since 2012, 2012 earlier last year. Single-family home prices have also slowed, but they are still up from the year ago levels. The condo market softness reflects ways the housing market and buyer preferences are evolving. Many condo buildings are located in urban downtowns, which are less attractive than they used to be for people who now work from home at least part-time. Condos are popular in second home markets, which have suffered from a slowdown in demand. Rising homeowner association fees due to higher insurance premiums and maintenance costs are also making condominium purchases less affordable. The rise in those condo HOA dues is giving a lot of buyers pause, says Kirby Arkes, a real estate agent in Portland, Oregon. Homes are just taking so much longer to sell. In September and October, condo prices fell 1.9% from a year earlier, the biggest decline since 2012, according to Intercontinental Exchange, financial technology and data company. More than 1 in 10 condos had a lower estimated value in November than their most recent sale price, according to Zillow. So just, interesting, condo versus single family. Condo seeing it much worse right now, over the last year or so. So again, just very interesting, something to keep an eye on here in 2026. Now this is interesting. So mortgage rates are falling, but owners still won't sell. So nearly 30 million households, or 54% of primary mortgage holders, have mortgage rates at or below 4%. So, and basically they don't want to sell. They don't want to leave. Mortgage rates have fallen to their lowest level in a year, but millions of homeowners are still locked into ultra low mortgage rates they don't want to give up. Nearly 30 million households, or 54% of primary mortgage holders, have mortgage rates at or below 4%, according to Intercontinental Exchange. They were able to buy homes or refinance their mortgages when rates fell to 3% or lower in 2020 and 2021. Now, many of those who want to move don't feel it is worth it to buy a home and take on mortgage rates that have doubled. This lock-in effect has helped freeze the housing market for 3 straight years, suppressing the number of U.S. homes for sale and keeping inventory well below historic levels for most of that period. We don't expect to see this massive influx of home buyers, especially while mortgage rates are above 6%, said Hannah Jones, senior economic research analyst at Realtor.com. People can't afford to move. Yes, I would agree with that wholeheartedly. Other factors continue to unsettle the market. Near record home prices are leading many buyers to give up. Expenses related to homeownership, including home insurance and property taxes, have also risen in many places. But mortgage rates remain a major stumbling block despite having fallen in recent months. Rates are unlikely to fall far enough to persuade many of those homeowners who want to sell to take on a far more expensive loan. Economists don't expect significant declines in mortgage rates in the next year. The Mortgage Bankers Association forecast in December that the 30-year fixed mortgage rate would average probably around 6.4% in 2026. So, I am hopeful that mortgage rates will come down a little bit here before the end of the year. I mean, I'm holding out hope that will happen a little bit. But again, I would reiterate that I think right now the best case scenario is maybe you're going to get rates back into the fives, maybe 5.25 or 5.5. I think that if we get down to that point, that is literally the lowest you're going to see it. I do not see interest rates going back. I think that you being able to get a mortgage at 3%, 3.5, 3.75, 4%, I think you having the ability to get rates that low was probably a once in a lifetime event. I don't think like, unless an absolute calamity befalls us, unless the economy completely and utterly falls apart and falls to shambles, I don't believe we will ever see 0% interest rates, which will lead to mortgage rates in the threes. I don't think we're ever going to see that again. At least probably not in my life. If I got another 30, 40 years on this earth, probably not going to see that in that time period. That would be my guess. But who knows, right? Who knows? Who knows what could happen? All right, so that's what I got there. So again, we're seeing this rate lock-in effect where, and again, I don't blame them. I don't blame them. I think a lot of people would love to move to other houses, but they're sitting there and they're going, man, I got a 3.5% rate and I'm locked into that. And my mortgage is paid off in 10 years or 15 years or 5 years. And, so why do I want to give that up? I'm going to move to a bigger, nicer house, but then my property insurance is going to go through the roof. My property taxes are going to go through the roof. My mortgage payment is going to go through the roof, and it's going to cost me a whole lot more. Why do I want to do that? So again, you understand where people are thinking and where that's coming from. But anyway, all right, let's move on to some economic activity. So here was a very interesting article here from Investopedia, just the economic calendar. These are the government data reports we are still waiting on after the shutdown. So let's go down here. So January 8th, we're still waiting. October U.S. trade deficit. September, October housing starts. New home sales for October and September. October business inventories. November retail sales. November PPI. November U.S. import and export price indexes, third quarter gross domestic product, final update, November durable goods orders, December PPI. And again, a lot of this stuff should be coming out throughout the month of January here. Fourth quarter unemployment cost index, December U.S. import and export price indexes. So again, just some interesting things just to show that we are still catching up from the government shutdown. We are still waiting for a number of these data points to come in so that we can begin to kind of put that puzzle back together, as it were. And we'll keep an eye on that one. Okay. U.S. economy keeps powering ahead, defying dire predictions. So unrelenting American consumer spending through a sour mood and a cooling labor market. So this holiday season, people spent, man. People spent and spent and spent. So consumer sentiment might be going down. The employment market might be, cool, very cool at the moment. But people are still spending money. They spent record amounts of money this holiday season, baby. Didn't stop there. Okay, these next two ones are fantastic. So the U.S. economy expands at a 4.3% in the third quarter, topping expectation. Inflation pressures built up during the July to September period. Yes, but not that much. Seriously, not that much. Robust consumer spending and a rebound in exports have helped the U.S. economy grow faster than economists expected, according to delayed Bureau Economic Analysis released on December 23rd. So real gross domestic product expanded at a rate of 4.3% in the third quarter, up from 3.8% in the second quarter. So that is 2 straight quarters of over 3% growth. That is phenomenal. Now wait for it. I don't want your head to explode here. Wait for it. Atlanta Fed nearly doubles their fourth quarter growth estimate to 5.4% after strong data. So stronger economic data and delayed releases point to a more robust U.S. growth momentum toward the end of the year. So we are expecting now a fourth quarter GDP of 5.4%. I mean, just wow. Wow. That is amazing. Amazing. So again, the economy is not without its issues, housing affordability, so a weaker labor market. So it is not without its issues, but the economy is certainly, we are not certainly in nowhere near like recessionary territory. We're heading the other way. We're heading into almost, boom economic activity at this point. So which is phenomenal, because I think, again, and I always expected, and I think I said this last year, if anybody was on and watched the live stream, listened to the live stream a lot last year, they know that I said I expected a very bumpy 2025. I expected that the 2025 in certain respects was going to be a very rough ride with a lot of ups and downs. And I think in a very real way, it proved out that way. I think 2026 is going to, I think 2026 is being a very solid year. Not like an explosive year. I think a very solid year. And I think depending on how things shake out, midterm elections, other things that go on, I think that 27 and 28 could be historic years in terms of economic booms and economic growth and development. Again, I talked about this a little bit at the end of the year. People need to give what Donald Trump is doing a chance. The amount of economic investment that he's got coming into the US is trillions, tens of trillions of dollars. He has got an insane amount of money that's going to be flooding into this country for people that are going to build more manufacturing. And you know what? Yeah, maybe the manufacturing won't be like the 1950s or the 1960s, but it'll be a lot better than it has been in the last 40 years. I can tell you that. So I think there is a lot of just a tremendous momentum that's going to come through here. So I think 2026 is going to be a very solid year. And then I think 27 and 28 could be historic. We'll see. Like I said, there's a lot to happen, a lot to play out, but we'll keep an eye on that. The U.S. trade deficit narrows sharply to the lowest level since 2009. The United States continued to see improvements in deficits and surpluses with major trading partners. Boom, boom. The U.S. trade deficit narrowed sharply in October 2025, falling to its lowest level in 16 years, according to new data from the Bureau of Economic Analysis released on January 8th. The gap in goods and services declined by 39% from the previous month to $29.4 billion, the smallest monthly deficit since June of 2009. Economists had penciled in a reading of $58.9 billion. So October's reading reflected the continuing impact of President Donald Trump's global tariffs, as well as shifting business and consumer behaviors. The lower than expected number was driven by a sharp pullback in imports, falling by 11 billion or 3.2% to a 9-month low of 331.4 billion. This was fueled by a 2.7 billion drop in purchases of industrial supplies and materials, which partly offset the 6.8 billion increase in capital goods imports. So exports declined, imports increased. So exports increased by 2.6% or almost 8 billion to a record high of $302 billion. Bingo. There you go, baby. There you go. Imports going down, exports going up. You love it. You love to see it. Okay, the layoff pace in December hit its lowest level since mid-2024, Challenger says. So planned job cuts totaled 35,553 for the month, a 50% slide from November, and an 8% decrease from the same period a year ago, and the lowest level since 2024. Still, for the full year, employers announced more than 1.2 million cuts, up 58% from a year ago, and the highest level since the pandemic year of 2020. So 1 month does not a trend make. We'll have to give this a few more months to see what happens, but this was definitely good news that the layoff pace literally got cut in half in November. So that's fantastic. That's really good news there. U.S. payrolls rose 50,000 in December, less than expected, but the unemployment rate falls to 4.4%. So non-farm payrolls rose a seasonally adjusted 50,000 in December, lower than the downwardly revised 56,000 in November, and short of the Dow Jones estimate for 73,000. The unemployment rate fell to 4.4% compared with the forecast for 4.5%, a more encompassing measure that includes discouraged workers, and the underemployed dropped to 8.4%. So again, not what we want to see, but not horrific either. U.S. economy post moderate job gains in December. So again, employers created 584,000 jobs in 2025. The unemployment rate fell to 4.4% again in December. So U.S. payrolls climbed less than expected in December, while the unemployment rate came in below market estimates, signaling a U.S. labor market holding steady to finish 2025. The U.S. economy added 50,000 new jobs last month, down from the 56 payroll gains in November. And yes, and that's that on the jobs front. All right, now a little bit of tariff news here, real quick, and I'm almost done. Hang in there. Give me another 8 to 10 minutes here and we should be done, guys. So Supreme Court holds off on Trump tariff ruling for now. What's at stake for the economy? So the Supreme Court did not rule on the legality of President Trump's tariffs. Markets are awaiting the decision, which could have far-reaching impacts on trade policy and the U.S. fiscal situation. The court has the option to grant limited powers under the IEEPA and require only limited repayment of tariffs, along with multiple other options. Treasury Secretary Scott Bessent says he expects a mishmash ruling. Yes, at this point, I was really worried that the Supreme Court was going to come back with an absolutely absurd ruling and basically say, "Oh yeah, the president doesn't have the power to do this and that. He's got to pay the tariffs back." I like to think that some of the people on the Supreme Court are a little bit smarter than that, and they realize the economic implications of what it is they're saying. And I think that the delay here shows that the Senate, perhaps the initial sentiment or the some of the economic argument is starting to seep through, and basically they're starting to realize that, hey, listen, if we basically say that the president doesn't have the ability to do these tariffs and that they got to return all this tariff income, this is going to be a hot mess. It's going to be a hot mess, and it could cause all kinds of unintended consequences. And but I do have a tendency to agree with Scott Bessent. Could we see some kind of a mishmash ruling on this? And I think we could. I think we very much could. And I think the probability of seeing that is probably greater now than it was a few weeks ago. What that is or what that looks like, I don't know, but that might be where we're going here. So again, as I have more information on that one, I will keep everybody updated. Now, however, Trump will use other tariff authorities to get to the same place if the Supreme Court rules against him, says Kevin Hassett. So the National Economic Council Director, Kevin Hassett, said Friday that the White House could deploy alternative measures if the Supreme Court rules against President Donald Trump's use of emergency powers to impose sweeping levies. There was a big call last night with all the principals to talk about if the Supreme Court were to rule against the IEEPA tariff. What would the next step be? Hassett said on CNBC's Squawk on the Street, referring to the administration's use of International Emergency Economic Powers Act. There are a lot of other legal authorities that can reproduce the deals that we've made with other countries and can do so basically immediately. And so our expectation is that we're going to win. And if we don't win, then we know that we've got other tools that we can use that get us to the same place, he said. So, I mean, all right, we'll see. Maybe we'll see. U.S. slashes proposed tariff on Italian pasta from 92% to single digits. Italy says, "Oh, thank goodness." Whew, man, I love my pasta. I was a little worried about that one, man. I'm part Italian, man. I love my pasta. All right, the unexpected winner in rising American tariffs is Mexico. Its exports to the U.S. have surged since President Donald Trump imposed new duties on countries this year. So how fascinating is this? So when President Donald Trump began raising tariffs earlier this year, government officials and economists feared Mexico's export-led economy would take a devastating hit. Instead, Mexican exports to the U.S. have grown because Mexico's ultimate tariff rate ended up lower than for most other countries. The disparity has helped Mexican exports fill some of the gap left by Chinese products subject to higher levies. Producers seeking a foothold in the U.S. have said that Mexico still has all the inherent advantages it had before tariffs. Its proximity to the U.S., low-cost manufacturing industry, and a frayed but intact free trade agreement. Even with steep tariffs on auto, steel, and aluminum bound for America, Mexican manufacturing exports to the U.S. rose almost 9% from January to November, compared with the first 11 months of 2024. According to Mexican government data, auto industry exports to the U.S. fell close to 6% during the period, but exports of other manufactured goods surged 17%. Trading goods between the U.S. and Mexico is on track to reach a record of nearly $900 billion this year. So very interesting indeed. So, all right, just some other banking news articles here real quick. So JP Morgan will no longer work with proxy agents. Again, I think this was a big deal. Just as much of President Trump coming out earlier when we talked about him wanting to ban large companies like BlackRock and State Street buying single-family homes. This one was equally as important. Basically, it's a very significant victory for and a validation of the efforts of conservative shareholder advocacy groups. Fund manager William Flagg said, yes, so JP Morgan Chase added to what has already been a hard year for proxy advisors by stating that it would no longer use the services of firms such as International Shareholder Services, Inc. and Glass Lewis and Company, which together hold a virtual duopoly in the business of advising fund managers how to vote at shareholder meetings. In an internal memo, JP Morgan stated that its asset management division will instead use an internal artificial intelligence powered program to help determine how to vote the shares it owns. The program, called Proxy IQ, will analyze corporate voting issues across more than 3,000 annual shareholder meetings. Although JP Morgan did not publicly detail the reasons for this move, CEO Jamie Dimon in his 2024 letter to shareholders cited problems created by misguided proxy advisors as one of the reasons fewer companies are willing to list on public exchanges. Yes, I would agree with that 100%. These companies are woke as can be, and they're pushing the ESG agenda, which is part of the DEI agenda, part of the CRT agenda, and that crap needs to go. That crap's got to go. I'm tired of all the climate change nonsense. That, you know, again, this has got to change. You know, and these companies tried to push this crap down the throat of every publicly traded company in America, in the world, and it's just it was time. It was time for this nonsense to end. Now, I will say on another caveat, you know, they're going to use this AI program. I don't know how good that may prove to be over time, because we have seen that some of these AIs are leaning in a certain direction. I'll say it that way. And so again, can these things be manipulated? I don't know. I don't know yet. That's a little early to tell, but I'm kind of considering this like a partial victory. So, okay, and then let's just look at it. Former Piedmont Bank executives start Georgia de novo bank. The bank, aiming to serve small business clients, is scheduled to open in late February or early March. Good for these guys. So, having received regulatory approvals, the founders of a Georgia de novo community bank are closing in on a minimum capital goal of $25 million. Georgia Skyline Bank, based in Roswell, got the okay from the state's banking and financial department and the FDIC last month. The new commercial lender seeks to offer white glove, relationship-driven banking services to small businesses generating between $2 million and $50 million in annual revenue. Good luck to those guys. Hope they do well. Bunk reapplies for OCC license. The Dutch neobank sought a U.S. license in 2023, but withdrew after a 301-day wait. It obtained a broker-dealer license in October from FINRA. So that's kind of interesting. We'll keep an eye on that. Michigan's Zeal Credit Union to buy another Up bank. So the proposed purchase of the minor state bank follows Zeal's acquisition of Gigebic Range Bank, also in the state's Upper Peninsula. The miners deal is the first credit union bank tie-up of 2026. So again, the purchase of banks by credit unions continuing in with the first purchase this year. Feds Bowman and lawmakers suggest regulatory threshold changes. We kind of talked about this a little bit earlier. The vice chair for supervision also wondered whether a more nuanced approach would be better than single metric thresholds, such as those based on asset size. Perhaps, maybe, we'll see. Plaid hires FDIC chief Jelena McWilliams. The fintech CEO praised the incoming president of corporate and external affairs as a consistent voice for transparency, consumer protection, and innovation in a blog post on Thursday. So Jelena McWilliams finding herself a new job. Instacart scraps variable pricing experiments after consumer groups warned of inflated grocery bills. The company said it ended the pricing tests after criticism that the practice risked quietly inflating grocery bills for cost-constrained households. That means it was shafting poor people. Just so I could read through the verbiage there. It was shafting poor people and shafting middle-class people as well, undoubtedly. But this is stuff that we're going to have to, all of us as consumers, we're going to have to keep an eye on this. And don't think the airlines are not doing all of this right now. So, yep. We had that, and then last thing, TikTok signs deal with U.S. investors to form data security joint venture. So the agreement would place U.S. user data and consent oversight under a new American-controlled entity as ByteDance retains algorithm ownership. So I really don't like that ByteDance is retained. That, I mean, because this gets back to the heart of the issue. The heart of the issue was that China was using the algorithm to push all kinds of nasty crap on American citizens through the TikTok app. That was the whole point of this whole thing, was to cut that off, and yet they are retaining ownership of the algorithm. That doesn't make any sense to me. It's like, what the hell was the point? I'm sorry, hold on. What was the point of all this if this was going to be the end result? Like, I don't. It makes no sense to me. It makes no sense to me. Stupid. But anyway, all right. So let me go into wrap up mode here before I get to my story of the week, and let me find my banners here. So before I get to my story of the week, I'd like to just go over a couple points here real quick. So reviews on Apple Podcast and Spotify. Oh my gosh, I forgot to mention. I'll have to show it to you guys next week. I actually got honored by Spotify. I couldn't believe it. Let me see if I can find. Can I find? Bear with me for just a second here, guys. Let me see if I can find this post on X. Let's see if I can find this. Let's see here. No, not that. I was hoping to find it. All right, I'll find it. I'll show it to you guys next week. So I actually got honored with a few awards from Spotify, which was really unexpected, but very cool. I got 2025 Rising Star, which was really awesome. But like I said, I'll share that with you guys next. I can't believe I forgot to show that this week. But yeah, it was very cool. Being honored by. I thank Spotify a lot. If anybody from Spotify is out there listening, I don't know. But thank you very much for the awards. It's very much appreciated. But if you listen on Apple Podcasts or Spotify, please make sure to leave me a review. Some of you have been kind enough to leave me a few reviews over the last few months, and I really appreciate it, but I do need some more. So please leave those reviews if you have them. If you have not visited thebankernextdoor.com, please do so. Please go check it out. I've got a lot of stuff on there, more stuff coming this year, hoping. Make sure you subscribe to YouTube to get the latest updates via posts. Like, if you want to know what episodes are coming out this week, if there's any changes to when the Strategy Room live stream is going to be on, make sure to subscribe on YouTube and hit the button so that you can get all the latest and greatest posts from me. Be sure to send comments to info@thebankernextdoor.com. That's how you reach me. If you want to ask me a question, I always love topic recommendations. If anybody's got a topic recommendation, you can send it at info@thebankernextdoor.com. Make sure to follow me on social media at GetterX and Truth Social. I know this is kind of a side note, but it's just kind of an interesting thing. Somebody asked me toward the end of last year, like I understand X, but why are you up on like Getter and Truth Social? So believe it or not, I actually saw an analysis that said that at the very beginning of the show, I talked about kind of what my demographic was and who I was focusing on. I saw a consultant's report that basically said that those were great places for my demographic, and that's why I ended up on those platforms. And so far, it's been great. I mean, I've got almost 5,000 followers on Getter. I got a bunch of followers on True Social, some good followers on X. So it's been, so again, they based on the consultant's recommendation, actually worked out pretty good. So that was just, but like I said, just in case, I don't know if somebody out there was curious. BND Strategy Room is on YouTube, Rumble, and all major podcast platforms. New episodes every week, Monday through Friday, premiering at noon, and BND Strategy Room every Saturday night at 8 p.m. So, okay, now let's go to our story of the week, and then I will do our quote of the week. Let me get that up here real quick. So, okay, story of the week. So the CBOE Volatility Index, otherwise known as the VIX. So the CBOE Volatility Index, the VIX, or the Fear Index, as it is widely known, is a real-time index that represents the market's expectations for the relative strength of near-term price changes of the S&P 500 index. Because it is derived from the prices of SPX index options with near-term expiration dates, it generates a 30-day forward projection of volatility. The index, which tracks the expected volatility of the S&P 500 through call and put options, volatility, or how fast prices changed, is often seen as a way to gauge market sentiment, and in particular, the degree of fear among market participants. The index is more commonly known by its ticker symbol and is often referred to simply as the VIX. It was created by the Chicago Board Options Exchange, the CBOE, and is maintained by the CBOE Global Markets. It is an important index in the world of trading and investment because it provides a quantifiable measure of market risk and investors' sentiments. So that is the VIX, or the Fear Index. So, and now our quote of the week. This comes from Rene Descartes. So, the reading of all good books is like a conversation with the finest minds of past centuries. So I like that. As an avid book reader, as someone who reads a ridiculous amount of books, the reading of all good books is like a conversation with the finest minds of the past century. And that was from Rene Descartes. So, all right, everybody, I thank you so much for joining me tonight. I don't know what happened, Bear Packers. I'll find out in a few minutes here. But again, so hey, I hope everybody has a great weekend out there. Enjoy all the football. I will have all new episodes coming out this week, Monday through Friday. BND Strategy Room will be back next week. Like I said, Saturday night, 8 o'clock. Looking forward to a great year here with everybody. Look out for all kinds of interviews and specials. And I even have some special live streams that'll be coming up too. So keep an eye out for that stuff here in the coming over the next couple weeks, next 2 months. And but with that, I will see everybody again. Have a great weekend out there. Until next week, be safe. And I will see everybody again real soon. Thanks a lot. Thank you for listening. I really appreciate it, and be good.